Hey, hello everybody. Thanks for joining us. I'm Connor O'Brien, CEO of O'Shares Investments, and with me today is Cynthia Murphy, who is head of ETF Think Tank. How are you, Cynthia?
I'm great. How are you, Connor?
All right, very well. It's been a few months since we had one of these sessions. I'm looking forward to today.
Me
It's had
too.
a great end of year and start to this year. We won't talk about the markets, but hopefully had some fun with family and friends.
Hey, it's as I was telling you before we started the show, I have two kids in college now, and this was our first holiday season with both of them gone. So that whole like movie, like they come home and the dog is barking and the house is packed and the fridge is raided. It felt really special actually this year to have the
Beer
house.
fridge, I guess, at this college age.
Yeah, exactly.
Oh, that's fantastic. Yeah, I got a bit of skiing in and really enjoyed that with daughter who was also home. Hey, so before we jump into these macro topics that I'm really looking forward to going through, tell us a little bit about what's going on at ETF Think Tank and Taroso Titled parent company. You guys raised money to expand your platform to bring out new ETFs with partner companies. Everybody's interested in hearing what ideas are coming next. You see a lot of them. Just share a little bit of what you're seeing with us.
Yeah, so the ETF Think Tank is the content research unit of Tidal, which is a white label platform, a multi-manager platform. So, Tidal is in the business of helping others bring ETFs to market. And what's been fascinating to see is just the volume of ideas. We're being hit with about 50 new ETF pitches a month. And everything under the sun you can imagine, most of it actively managed, because I think the passive traditional beta space is pretty covered. So we see a lot of innovative ideas in active management. We are seeing a lot of interesting ideas in alts or options-based strategies. A lot of it using derivatives, since the derivatives rule kind of level the playing field for the use of derivatives and ETFs. We're seeing a lot of innovation come in that space. So it's been kind of exciting to see that, as we mark the 30th year of the ETF industry this year, there's still so much more to come in new and novel ways to slice and dice this market. So it's exciting to see that side.
Well, we'll talk some more in a few months about the new ones that have actually made it to your product launch and learn some more at that time. In terms of O'Shares, for those that haven't caught up with our updates, we've a few months ago done a deal with Alps ETFs, and so now our O'Shares ETFs are under their banner, and we provide the indexes and research and so on. So we're very much fully involved and happy to provide research and information to advisors regarding our indexes that drive those ETFs and other research, some of which we'll share with people today. One of the things we've noticed, it's pretty obvious to everybody, last year was kind of a year during which liquidity was being pulled out of the market by the Fed, and the markets just came down by, pick your number, 20% across most of the major indices, and even greater decline across a lot of the frothy growth categories and stocks. Some of them still have good business models, and some of them don't have great business models, and some of them never had a business model. I like to pick on crypto. You guys have some sort of a blockchain-related ETF. How did that fare last year, and has it had the big bounce in the early part of this year?
Yeah, it was a rough year for anything related to crypto, blockchain, that disruptive growth story, the DeFi story. It's, as you know, the asset prices just plummeted. I mean, these funds were down, 40, 50%. And we have in our platform, Block from Amplify is on the Tidal platform. And that's a fund that lost almost 50% of its assets, not by redemptions, just by market performance. So what was interesting to see from where we sit was just that the performance just was terrible, but the assets were surprisingly sticky. So I think investors are still committed to the long-term growth story of this disruption in the crypto digital space. But they just, we went down kicking last year. It was really bad for everyone involved, for sure.
Rough ride. Well, I'm happy to say I've, as of now, never put one penny into anything crypto related. But that's not because necessarily I'm smart. It's just because don't really want to get into something like that.
I put a few because I wanted to see what it was like, and I've lost most of them. So
Yeah.
maybe you were smart.
Well, you can see how they're doing just by looking. I do look. I'm kind of curious on how much this crazy money flow is just driving things. So speaking of money flow, back when I was studying economics, people were always talking about money supply. And it seems like nobody cares about money supply or cares to talk about it these days. But I took a look at it. I looked at the St. Louis Fed database, and it's kind of interesting. It shows money supply, of course, went ramping up really, really aggressively during the COVID, let's call it rescue flow of funds into everyone's bank account, everyone's. And so I was looking at M2, and most of us probably forget what M2 is, but M2 is basically a measure of cash on the street plus cash in checking and small denomination savings accounts. And so it's just considered one of the multiple metrics. $15 trillion of M2 January 2020, $22 trillion Jan 22. So you got 7 trillion thrown on top of the 15. That's almost a 50% bump in 24 months, in 2 years. But what's really even more interesting is Jan of this year, we're down. So the money supply is actually down. And so this is the Fed taking action. The prior 2 years of that incredible run-up is what drove everything up. Price from Bitcoin to frothy stocks to good stocks as well. So let's take a look at some CPI data. I'm just going to flip us through a few slides, and then love to hear what you guys are hearing from advisors. The first thing here is CPI, and everyone hears headline CPI, and okay, it peaked and so on. But really what the Fed looks at is the stickiest, most difficult part of CPI, which is the blue line, which is basically labor costs. And labor costs flattened off, but it hasn't yet taken a sharp turn down. And so what we expect is the Fed is going to continue to have a foot on the brake until that line starts to trend back down where they want to see it. And if you look back to 1979, 80, most of us weren't investing back then or even around back then, but you'll see that the Fed, they kind of made a mistake, and they took the foot off the brake too soon, and then had to go back to a very aggressive move on the brake. And I suspect that Powell doesn't want to do that. So it's quite likely that we see rates stay at elevated levels at risk of being a little bit too long, rather than taking the foot off the brake a little bit too soon because of that mistake that was rather historic and yes, 40 years ago, but that is that's the Fed memory. They know, they remember. So that's the CPI chart. Let's take a look at the next chart here. It just shows the dot plot, and I would suggest to everybody just kind of discount heavily the further dates. Look at near term. We're already at near the 4.5 zone, going up to just over 5. Those are most likely scenarios. And then as you look further out, yes, all the Fed governors have their various dots, expecting to take Fed funds rate down over the next few years, down to call it the 2.5 area. But there's an incredibly wide range of expectations in 2024, 2025. It's going to be very data-driven, and likely to be very persistent foot on the brake until they see the labor costs come down. And we just flip to the next slide for a sec. You'll see what the market did. This is basically a 3-month move from October to now, 100 basis point downshift of the yield curve. That's quite surprising. That's what actually fueled the rebound of growth stocks and equities in general. And it's maybe a bit too far too soon, because we're not going to get another 100 basis point shift in the next 3 months. That's very unlikely. So I just thought I'd share that with people, because that probably fueled a bit of a rally. The next chart just shows where the performance came from all of last year. And so you got this roughly minus 20% across these major indices. The dividend stocks in almost every sector outperformed. 10 of 11 sectors, the dividend payers, were massively better at cushioning the downside. And it's just a reminder to people, if you actually want to cushion the downside, owning an allocation that's tilted towards dividends can be quite helpful. And in the box there, you see the indices. The sectors are to the left side, and then on the right side are the various indices from the S&P on through others. And by the way, anyone who wants these slides, be able to get them from us, send us a note, info@oshares.com. We'll provide you the slides afterwards, or send a note to Kay Beatles at O'Shares. He's our Director of Capital Markets. One last slide here just shows the last quarter. So this is basically what happened when the yield curve started to shift downward you see the data in the top box of yields in a 10-year coming down while Fed funds rate going up, and CPI month over month data flattening off. What we noticed, and this is an area where you've got, I think, a lot of interesting information to share with us, Cynthia. Dividend strategies, they performed very well through those 3 months, outperforming the other categories of value, growth, et cetera, outperforming the S&P, outperforming basically all the other categories, and attracting money flows. So let's talk about money flows for a little bit here. You've got all ETFs within your parent company's group of ETFs, and you look at a broader set of ETFs as well. What did you notice about money flows in the last few months, the end of last year, and what are you seeing now?
So a couple of things I would point out is on this dividend story, I don't think there was a bigger story last year than the dividends. Everybody was buying. If you look at funds like especially your high yield dividend, the appetite for those ETFs was insane. Like billions and billions of dollars went into these funds last year. And it's because nothing else for anybody looking for yield was working. So it makes sense that people started really focusing on that equity income opportunity. And they were great performers, and they were yielding 4 or 5 times what everything else was yielding. So it was an appealing asset class. And, these are stocks that tend to tilt towards quality. They tend to, they have strong free cash flow. So they are positions that hold up better, and they're a little bit less volatile than the rest of the market. So it was really a really strong part of the market. I think, what we've learned, to go back to the money supply, the easy liquidity that we all just got so accustomed to, is that we got so focused on price for so long, and everything was rising. So we just chased those prices higher. And I think now we are faced with the fact that fundamentals actually really matter. Quality actually really matters. And so it's been an interesting, maybe relearning opportunity or refocusing a little bit away from price and for the bigger story behind each of these securities that we invest in. So from that perspective, in the dividend story, I actually am a bigger fan of the dividend growers rather than the high dividend yielders, because you can have a company that is shelling out really high dividend yields, but not for the right reasons or not for a good reason. Where the dividend grower space, these are stocks that they tend to have consistent dividend growth for at least 10 years, sometimes 25 years. I mean, that's a long track record of strength, of quality, of strong fundamentals. So I think the dividend grower space is going to remain interesting as we move forward, even though this year we're seeing a lot of money find its way back to fixed income, which last year didn't work for anybody. And this year is the most popular asset class. I think we haven't even finished the first month, and more than $20 billion have gone into U.S. fixed income ETFs already this year, while money in general has come out of U.S. equity ETFs. So people are refinding that fixed income sleeve because it's yielding actually more than, I think you can get 4% on a treasury versus 1.7% on the S&P 500. So it's the yields are attractive again. They're lower risk. The correlations between bonds and equities are going back to their normal inverted relationship. So it's a space that we've seen investors come back to navigate the risk that we're seeing.
Yeah, it does make sense, because a lot of people did lighten up on fixed income and maybe save their clients a heap of downside. It's very crazy how correlated it all was last year. I love the line you said that people are investing in high dividend stocks because nothing else was working. And so they obviously work better than the rest of the equities. When you speak of dividend quality and growth, you're definitely speaking the DNA of our ETF indexes, OUSAX and OUSMX, where dividend growth and dividend coverage are very important metrics that determine if the stocks make it in the index or not. And coverage really is our view of ability not only to pay the dividend, but ability to grow the dividend. If your coverage ratio is getting tight, the odds that you're going to be able to grow your dividend also tighten up a little bit. So let's spend a minute let's call it thinking, speculating about what happens next. So the Fed's basically at some point going to flatten off. The Canadian central bank today put rates up 0.25 basis point and said we're going to pause. we're going to wait to see if this move that we've put in place does what was intended. A bit premature to think that the U.S. Fed is going to, as early as the next meeting, say something similar, but who knows? Let's see. At some point soon, they will pause. And so we took a look at this. We said, well, what happens for the 12 months after the Fed hits the pause button, after a rate rise cycle, strong cycle, before any cutting, they just stop going up? What happens? And we took a look at small caps versus large caps. Because we've noticed there's been flows into our small cap ETF that uses our index, and so investors are taking notice. We've also seen that small caps as a valuation metric are cheaper than the long-term historical averages, whereas large caps aren't really, unless you only look at very recent, it's called the COVID-driven period. If you go look back quite far, you'll see that large caps are still at higher valuations than long-term averages. So this chart you see here, I guess we sent it to you earlier, so you would have seen it. The positive 3.8 reflects the outperformance, the amount of outperformance by small caps versus large caps during the 12-month periods when interest rates, when yields, the 10-year actually, yield was going up. And what's interesting is when it was the other way around, when the yields were declining, you had outperformance by large caps. And of course, if you average those two periods together, you got about the same performance across large and small for that long period of time, 20-year period of time. So we really use monthly data to say, okay, for a 12-month period, what happened with yields? Did they go up or go down? And if they went up, you put them in the left-hand bucket. If yields had gone up, you put them in the, down, you put them in the right-hand bucket. So it basically makes the point that small caps can do well during a period of increasing yields on the 10-year. And
well, if I may chime in, Connor, we started seeing money find its way into small cap ETFs kind of late last year and continuously through the beginning of this year. And so when we were talking to folks trying to understand, because in a recession, if we really hit a hard recession, which by the way, I'm so amazed at the lack of consensus on whether are we in a recession, are we going to get a recession, we're not going to. The divergence in opinions and whether there is a recession or not, I think is fascinating. But anyway, in a recession, small caps would perform poorly relative to large caps. But what we heard from advisors is that this bid, the discount of small caps to large caps got so wide. And in the case that we don't have a hard recession, that we just kind of struggle a little bit and start to recover, small caps will outperform. Investors already started buying, putting a bid in their small caps, whether they're dollar cost averaging into those positions. Small cap value specifically did really well, really late last year and early this year. So it's so interesting because it tells you that the long-term investors, they're not really buying into the doom and gloom scenario. They are thinking, you know what, the Fed is going to slow down, inflation has peaked, maybe things will just work out, and they're already starting to buy these positions.
And then the very things change, the market goes the other way. It's a very nervous market. I don't think nervous bad. I just think it's such as you've said, a wide range of views on what to expect next. We took a look at one more way of looking at this data that's small cap versus large cap in the data table on the next slide. And basically shows a 19% positive return in the 12 months after the end of a major rate hike. Major meaning more than 150 bips. And what you see in this table is that small caps were positive all four of those periods. There only were four of those such periods, and averaging 19%. Large caps also average 19% with wider range of outcomes from negative 10.6 to positive over 30. And so again, it's just to make the point to people that if you're underweight small caps, maybe you want to, if you want to position for the eventual flattening off of the Fed's rate move, small caps maybe deserve some consideration. They've got a history of doing pretty well, and in fact, some might say maybe it's better, a lower risk version of 19% average than S&P, because the S&P had that down period at one particular time. Of course, it's year 2000. That's the tech bubble for those who were around or at least remember the tech bubble. The other point on this page is the discount. You mentioned that a bit. There's a 12% discount right now that compared to the normal ratio, PE ratio of small cap to large cap. You right now would see that small caps are cheap compared to that historic ratio. So it's one more reason to give small caps some consideration.
Yeah, it could be even just a story if you think about from rotation, sell some of the winners and buy some of the laggards. So find interesting valuations in small cap, finding interesting valuations in international equities. Even from sector perspective, we've seen, tech and growth do well beginning of this year. Is it because people believe that the market's going to rally, or is it just because those are the most beaten down sectors from last year? So people are taking some profits on energy and rotating into the laggards. So, all these things we're seeing happening as a kind of a repositioning opportunity, and small caps fit into that as well.
Yeah, we think tech got a bit of a relief rally as the yield curve shifted down by 100 basis points since October. Everyone knows that the growth stocks benefit from a lower interest rate environment. Even if the growth isn't there, the valuation driver, that discount rate, at least was helpful. Let's talk about earnings outlook. And the earnings revision for the S&P keep coming down. Revision for next year. Well, sorry, next year, I mean the year we just started. And now looks like we're going to head for an expected earnings recession. So there's more and more consensus around the earnings recession than economic recession. What are you hearing? What are you seeing from people?
Yeah, it's the exact same that you're mentioning. It's concerns about profits, they're coming down. Access to capital is more difficult. Rates on capital is more difficult. Profits are gonna feel that punch. Earnings are gonna suffer, which is also part of the reason why when we come for that income story, people are preferring government bonds versus corporate bonds. There's a concern about what happens there. High yield looking particularly vulnerable to an earnings recession. But I have not heard a single positive outlook on earnings in the near future. So unless everybody is wrong, which I guess sometimes can happen, I think it's in the cards that it's going to be tough going forward.
Yeah, I mean, everyone was wrong, I guess, driving markets up as high as they went with all that free money from the Fed and other sources. And you take away the punch bowl and the party sort of winds down to a quieter valuation of it. Maybe we're overshot today now, so maybe not yet. So the earnings growth estimates for this year that we're just in, negative 2.8% is now the number on the S&P, with growth resuming next year in 2024, basically getting it back. But what is interesting is the sales growth estimates are positive. So this is really a margin compression situation. And if you look at which sectors are contributing to the declining growth, it's basically healthcare and IT. Whereas if you look at the earnings growth in 2024, it flips. Energy is expected to be negative 20%. Materials and real estate, negative 14, negative 7. So those are the big contributors to pulling earnings growth down in 2024, whereas the rest of the sectors begin to rebound. And the final thing we talk about dividends, we look at dividend growth expectations. For the S&P, the dividend pair is expected to be about flat for this year and then up 6% for next year. We've got somewhat stronger dividend growth in the OUSAX index and the OUSMX index, which we're happy to share with people if they request that info. But here's the question of what markets might do. What's your speculation on your guess on when the markets start to throw in the towel on 2023 and just say, to hell with it, it doesn't matter anymore. That year's far advanced. That's going to be a bad year for earnings, but we're going to start to price stocks off 2024 expectations. How many months, what point in the year do you think we get that transition of focus?
It's a great question, and I wish I had a great answer to it. I honestly have no idea. What I think is interesting is just this conversation about a complete disconnect between what the market is saying and what the data is telling us. So I think at some point we actually get worse before we get better. At least that's what all the data is suggesting. So whether that's going to be second quarter, second half of the year, or sooner. I mean, it could be that the Fed surprises and people get overly excited or overly bearish. I think we are so struggling with this tightening, with the lack of liquidity, with the reality that the easy days are over, that we're very quick to react and to try and find any reason to restart that bull market. So I think we may have some fits and starts here before we are done hitting the ground. I mean, just this week, I've read at least 3 different macroeconomists talking about S&P 500 at 3,200, that we have to get back to that pre-pandemic level before we purge all the excess and can get back to a sustainable bull market. Is that right, wrong? I don't know, but it's 3,200 is a long way from where we are today. So it looks a little painful.
Yeah, that would be a long way down. I think it would require a lot of money supply being pulled out, much more than the Fed is likely to want to pull out of the economy. But there seems to be a market bouncing between expectations, it's called hopeful expectations that the Fed's going to talk about flattening off and easing up and flattening off. And those are on the positive days. And then you see this earnings concern that drives negative days. And go through a few months of that. We're going to go through this earnings season and maybe next earnings season with that kind of volatility in terms of green days and red days, until the Fed says, okay, we've accomplished, we've crushed CPI, and we'll gradually trend towards a more normalized interest rate environment. We think it's kind of likely that that's what we live through for a little while here. That kind of a volatility, earnings disappointments driving downside, optimism on CPI, Fed easing up, driving upside. And if somehow earnings actually surprise, change that expectation to one on a more positive side. But, the consumer and the money supply being sucked out of the system is likely to cause a slowdown, not just fourth quarter when those numbers come in, but for the quarter we've just started as well. So I think we probably run through the half hour that we've kind of allotted for this. What I'd love to do is just invite people to get more info from you, from us. People want to get more information from the ETF think tank and from you, Cynthia. How can they reach you, and how can they get info from you and on your research?
Yeah, I mean, it's all our stuff is available on our website. It's free. It's etfthinktank.com. Very easy to remember. You can, my contact information is there. We're always open to conversations. We talk to both sides. We're talking to advisors and issuers every day. So it's a great place to come and get a sense of the pulse of the market, and join us in the conversation. So we would love to have you.
That's fantastic. We love the perspective that you bring to the ETF market and to this conversation, which we'll do again in a few months. I'll put on the screen here just a list of things people can get from us, from the O-Shares research team, information on the macro data that we've been talking about, equity performance and yield trends, performance on small versus large caps, and of course, information on our key indexes and the overview deck for those. info@oshares.com is one place to reach us. kbeatles@oshares.com is how to reach Kevin Beatles, our capital markets director. So Cynthia, it's been great to reconnect here, and look forward to our next conversation maybe in 2-3 months.
All right. It's always a pleasure. Thank you so much for having me.
You bet. Thank you.